Analysing Accounts Receivable by Brianna Brown. An account receivable is the amount owed by a customer to a company for their good or service. A company must keep track of their account receivables. Better collection of the receivables means more revenue for the company. There are three main methods of analysing accounts receivable: horizontal and vertical analysis, the receivables turnover ratio, and the allowance ratio. Horizontal and vertical analysis is a good way to begin to analyse accounts receivable. Horizontal analysis is the comparison of a dollar change in account balance over a certain period of time. The first step in calculating horizontal analysis is calculating the dollar change by taking the current year balance and subtracting the prior year balance. The percentage change in these accounts can then be calculated by dividing this dollar change by the prior year balance. Whereas vertical analysis compares a company's account balances within a single year. This is done by dividing each account balance by a base account, leaving a percentage. Vertical analysis is achieved for the balance sheet by placing the account balance over a company's total assets. For the income statement, the account balance is placed over the net sales or net revenue. A receivables turnover ratio analysis is a company's ability to generate and collect receivables, indicating the amount of credit sales and then the amount of these sales that a company can collect. The first step in calculating this ratio is finding the average receivables. This is done by adding a company's beginning receivables to their ending receivables and dividing this number by 2. The second step is to take credit sales and divide it by the average receivables. The final method of analysing accounts receivable is the allowance ratio, which aims to identify the percentage of the accounts receivable that are expected to be uncollectible. The first step in calculating this percentage is finding the gross accounts receivable by adding the net accounts receivable and the allowance for doubtful debt. The second step is dividing allowance for doubtful debts by the gross receivables. A higher ratio shows that a company expects a large amount of their accounts to be unreceivable. This is bad for the profit of the company as it reduces their cash flow.
Created using Powtoon.